Hey everybody, good afternoon. Welcome to 12-Minute Trading. This is Doc Severson. I'm joined with Dave Lukas here. Today is Monday, the 18th of November. All right, so we got just a few weeks left, 6 weeks or so left in the year. And man, all kinds of volatility. First, we went straight up 300 points on the S&Ps right around the election time, and we've given back half of it. And right now, Dave and I were just talking offline, quite honestly, I don't know what to expect into the end of the year.
Mm-hmm.
You know, if you'd asked me a month ago, I would have said, oh, hell yeah, no matter what happens, we're going to rock and roll into the end of the year. And now I am not so sure. What are you seeing out there, man?
I still think it's intact as of now. I mean, this seems like a very, we got over our skis, right? So we went, way too far, too fast last week. We got outside the upper Bollinger Bands and we've given back 50% of it, right? Coming right back into kind of the area that we would have naturally gone to if we were grinding higher, right? So to me, that's not shocking to see us come back down to earth a little bit. Now, we've talked about a lot of the underlying macro things that exist out there in this market that eventually are going to hit. And you and I have looked at history, like comparing it to the 80s when Reagan took over from a similar time and before that. And, Reagan had an 18-month recession in his first term. That was pretty, horrible recession to the fact that, Volcker had to jack rates to 18% to get out of the inflation from the Carter days. Now, could you imagine if we jacked rates to 18%, what would happen, right? We didn't have 36 trillion in debt back then. We didn't have a type of debt level that we have, right? So this is, a much different animal in that sense. And so they can't jack rates. They can't do that. The Fed knows that, and everybody else knows it too. That's why you see the 10-year and everything going up. So it's kind of a catch-22, but that tells me that we're probably going to be continuing to have some inflation, that inflation probably is going to rear its ugly head again. It's every spike like this we've seen before, it's going to happen. And markets are going to have to deal with that. But ultimately, markets left to right, higher over time. And part of that's because the dollar's losing value, right? So in the interim, where we, kind of expected a rally into the end of the year. I still think that's intact. We may have some turmoil through this week, and we got to get through NVDA earnings. Typically, Thanksgiving week's a fairly solid week, and then it kind of takes off from there, right? Through the end of the year, you get your Santa Claus rally, and then January comes, first quarter. We've said it before, kind of all bets are off at that point, right? Think about it this way, and I'll let you bring up the charts and stuff. Think about it this way. So everybody's like, okay, we have too much debt. We're spending $2 trillion in deficits. We've got to cut government down to size. We've got the Department of Government Efficiency with Elon Musk and Vivek and all this stuff now, right? Well, think about it this way. The only thing that's propped up the economy for the last 4 or so years is government spending $2+ trillion every single year, more than we're taking in, going further into debt. So what happens if they actually do their job well? We want them to, right? But are we ready for the pain that has to come with that to do the right thing? Because if you cut government down to size and you stop spending $2 trillion extra, maybe even get a surplus, right? Well, that's going to come out of the economy because the government's been throwing it at the economy. So that is going to be a level set on a lot of what's been going on with these markets. And that's why if you look at a chart where we've just gone parabolic for the last 4 or 5 years, right? That's all because of that government spending. So if that's cut down to size, look for that to come back down. So won't be surprised if we get, Reagan, I think markets came down 40%, I think, in that 18 months. So I would not be surprised to go into a bear market to come off that sugar high of government spending if we're going to do things right and do what has to be done. Otherwise, we're just going to keep going into debt and it's going to end up collapsing on itself anyway. So we've just got to be smart about it and understand to watch for those turns, and you can take advantage. Even in a bear market, you can take advantage. So that's kind of how I'm seeing the future right now.
Yeah, let's I'm going to just jump into the charts here for a second, guys. Now, again, what I always say is I don't know what's going to happen the next 5 minutes, let alone the next 6 weeks or so. But what we can do is we can put up some some markers here to let us know if and when something is happening. So if we look at this 300-point swing, which is the latest upswing, notice how the price has come down to the 50% fib, exactly right on the 50% fib. So what I would expect to see is, quite honestly, I want to see at least the 61.8% hold, but if we flag out here, so in other words, if it just consolidates in this level for the next couple of days, then what we're going to be left with is a Darvas box, which is either going to break up or down from there. So we may find that Friday's candle kind of outlines the price range for the next few days. And from there, we can determine whether or not it's going to be a buy or a sell. If it's a sell, this is going to concern me, because more than likely we're going to come back down here to fill those gaps and kind of reset the election. And then any bounce that we have from there, more than likely, is going to be a lower high. So this could be a very first look at what's happening here. Now, in the past, we've seen these types of moves before too. And, every time we drop down, we end up just blitzing to the upside. But I think what Dave brings up is very much an overhang that we're going to have to deal with going forward. Like, all the sugar got taken out of the pot for this thing. So
if you bring fiscal responsibility to it, you're going to have to deal with the ramifications of that.
Yeah.
So we as traders, investors really need to understand that and realize that to do the right thing means you have to bring this market back down, to earth a little bit.
Yeah, when they rip the Band-Aid off, there's some initial pain that you have to go through. Eventually, it's great, right? So let's do this. I mean, Dave and I talked about this the other day. Let's go back to a similar. I think we would agree that the election results has the potential to be a transformative election. It's not elections as normal, right? So this is going to be a very different one. We're already seeing just through the appointments that it's going to be it could be a transformative election. And that's not a political statement. That's just like, it's going to be different than what happened 4 years ago. So go back to the Reagan election of November of 1980. What happened right after the election? We pumped. We went straight up and the market had sniffed it out already. Right, that Carter was going to lose, Reagan was going to get in. And then what happened after the initial pump? We dropped 100% of that, bounced up to a lower high. And what this started was the process of moving from quiet and trending into sideways and volatile. That is a transitory market character. Yep. And we eventually moved into, this is where rates got higher and things got out of control. This is a 30% bear. Doesn't look like it, but that's a whole 30% haircut. Now, after things changed here in 82, I think everybody would probably agree that things ended up being very, very good all the way through the rest of his term, all the way through 88. So that was 2 terms there. So the initial haircut from Reagan getting on board and doing the right thing here was about a year and a half of pain. Mm-hmm. And I wonder if we're going to have the same thing happen here.
The only thing that and Reagan did this too. Remember, when Reagan came to office, do you guys know what the top tax rate was? It was over 90%.
90%.
That was the tax rate. And so they did tax reform and everything else. Trump's going to do some of that too. Obviously, there was a big difference back then where there was these crazy loopholes where you could write all kinds of stuff off as not even a business owner, as just as a typical W-2 wage earner. But that's a big thing. And so, can they manage it where they cut some and then they bring down taxes, or you know what I mean? There's a lot of things that they have to kind of manage this with, and that's going to be really important. And so we just have to wait and see, but we must be prepared if they really start getting fiscally responsible and cutting things down to size for this market to start to go the other way. And I think your key is perfect. You got to look for the lower low and then the lower high, and that transition to that type of volatile and sideways kind of market, which ultimately gives way to a volatile and trending market, which typically goes lower. Um, so that's again, we just need to be prepared. If it doesn't happen, great,
Yep.
but we need to be prepared for that. Right now, we need to see, do we put in a lower low from right here, or do we run back up here to these highs, right? Or do we run back up and put in a lower high and start to roll over? That's kind of a mini change to like a volatile and trending, right? So that's the key over the next few weeks that we really have to watch
So
to really see where this thing goes.
I'm going to bring up today's charts again here for a second, but
Yeah.
I want to, I can't resist putting another one of these up. So here's another one from 1968. So before that, it was, LBJ presidency, and we were getting dragged into war. And then Nixon gets elected, and everybody's thinking that Nixon is going to be, he's going to be the peace, the peace president. And so he gets elected, and then what happens is a week or two of upside, and then what happens over the next several months, another 30% bear market. So there's history doesn't repeat, but it certainly does rhyme in these things.
Mm-hmm.
So I want you guys to be aware that, don't fall asleep on this market. Don't fall asleep on this market. Now, I'm going to bring up your favorite chart,
Mm-hmm.
which is, if I can find it here. Okay, so this is just a single price, single time frame on the S&P. Let me get the fibs out of here.
And we are bouncing at the perfect level right now, like
Yeah.
right on the moving average, right? Like I said that earlier, it's just, do we hold it? Like I would love to see this market. We have some softness midday right now, but if this thing rallies into close and holds this, that's a really good start, and we'll see if it can continue.
So watch what happens. This is what we do in the live trading room. This pink line is called the anchored VWAP. And I have borrowed this tool from a trader by the name of Brian Shannon, who's kind of written a book on this tool. And this is a fantastic tool to understand who's got the edge intraday. So what you're going to see is if we're in accumulation, you're going to see the price come down to the anchored VWAP and bounce from that level. So it represents value. Above the line, it represents, above value. This is below value. And so we're getting buying right now below value, which is, for now, it's good. But I agree with what Dave says. Watch what happens in the last, I guess we got 75 minutes left in the market today. And watch how this closes. The one thing that we noticed, though, is like if you look at, here was Friday's price action, and here was our opening range, was like basically like right there. So we started off the day on a gap down, went through the opening range, and then as we exited the opening range, it just puked from there. So, I mean, that's the type of downside trend day where the bulls just didn't have a chance. And so today we came into today, and it was much, much different. So we had a little bit of a gap up, not very much, but it was really gapless today. And then as soon as we printed the opening range, the buying started. So this has been a very different day so far. And I'm expecting this to hold up into the end of the day. I don't think we're going to see a total puke into the close or anything. And I think this is good that we're at least providing some support down here, support down at this level. I mean, again, guys, just to reset, I mean, we're only talking about 2% to the downside here. So, we're used to this trend. But I do want to mention that if we're going to see this start to move into distribution, we'll find out here in the next, couple of days before the end of the week. If this starts to break down through 5,800, then we may be going through another one of these moves again, even though technically we don't need it. And so here's another thing, and then I'll throw it back to you here. If we look at the S&P, and if we look at this through trend and energy, we get the fibs off of here. Trend and energy. Trend on the monthly chart to the upside. Energy, good. Trend to the upside on the weekly chart. All good. Look at the energy here. check. Trend on the daily chart has not been violated yet. We still have an uptrend. And as of today, check. So we have all three time frames aligned right now. So we have fractal alignment across all different time frames, and we have the potential to run, to continue running. Now, this is the key here is, will this energy continue running to the upside in terms of the longer time frame trends, or will this energy instead go counter trend? Mm-hmm. And that's what we saw a couple of times so far this year. We saw the counter trend energy kick in. So, and by the way, guys, let us know if you have any questions. And before I move away from here, I do want to mention that I do have a little presentation coming up on Wednesday. If you didn't catch this weekend's, if you're busy watching football on Saturday, which most people were, right? This Wednesday afternoon, I've got Creating an Income Campaign for 2025. So if you don't know anything about the income campaigns, or if you're just having trouble getting success in your trading, over the last year and a half, this has been our top strategy that has been responsible for most of our profits, at least in my account. So this has been, an easy strategy to run, and I want to tell you guys about it. If you show up for 45 minutes, you're going to learn pretty much everything you need to know about it, and then see whether or not you want to learn anything more. So you can also join. If you look at the video description, you can opt into that. It's a 4-day online event, so I think it starts tomorrow. And it goes through the end of the week. So make sure you join, and there we go. Okay, so let me know if you have any questions, and also if there's any other questions for the room, or for those of you that are joining us live, if you have any questions, bring it up. If there's something you want us to take a look at, go for it. Otherwise, if you're watching this through a replay, which is going to be most of you, let us know if you have any questions for next week's session.
Yeah, I was just watching on the screen over here, watching the different time frames on a few of the charts, and we seem to have started to come back around from a rally standpoint. This, from this softness we've just seen. I want to see if it holds though. But definitely the S&P has kicked in. It's back above 20. The NDX was down, only up 100. Now it's up 140. The Russell went negative, and now it's back positive by a couple points again. The Russell was up somewhere around 15 points earlier today. So see how that ends. All of these guys, they're hitting that support, like right at those moving averages, right in the middle of the Bollinger Bands. Even dipping below is being bought back above it right now, and I like seeing that. That's really good.
We actually have all hands on deck right now from the S&P sectors. The only one that's possibly negative is industrials, but right now energy is leading everybody, and that totally makes sense because that's going to be the thing. If we want to be Trump has talked about being leaders in the tech space, and if we want to be leaders in the tech space, we've got to have cheap energy, so that we can do all the R&D, and we can
fill the data centers and everything that.
Oh yeah, I mean, think about all the AI is just going to just pull energy like crazy. So we need cheap energy, and so they're working on that right now. So actually, the NASDAQ is up quite a bit.
Some of that's Tesla from over the weekend. I don't know if you saw it. Trump did come out and say that they really want to pave the way for autonomous cars and driving. So that fits right into Elon's plans. So that's part of the reason that you're seeing Tesla bouncing pretty big today.
Yeah. Dave, do you know why SMCI is up?
Right now, I haven't seen any news, but I haven't looked. Remember, SMCI, NVIDIA's third largest customer, was supposed to be delisted as of today. So, but they had till I think today to provide the evidence or whatever that the exchange was looking for, right? So they didn't get delisted. So we'll see if that ultimately pans out for them at the end of today. But right now, somebody might know something, right? They're pumping that stock up. I think it was up $4 or $5. So, so maybe they're not going to get delisted. That does bode well for NVIDIA later this week. I'm sure there'll be some questions asked about them, being the third largest customer on NVIDIA's conference call.
Well, there's
But
an article this morning. They reportedly will file a plan with the NASDAQ that will allow the data center specialists to avoid being delisted from the exchange.
there you go. So
So
that's the news on them today. And we'll see. Watch tomorrow. It didn't work, and the stock will drop by 50%. But no, I mean, I think they're going to find a way. I think NVIDIA is going to help them find a way. I would think so, being their third largest customer. Don't want them to get delisted or have those issues, right?
Right.
So we did get a question in. Do we typically sell puts, sell calls, or avoid selling options altogether during a bear market? Now, that's a good question. I'm going to answer from my side, and then I'll let you answer from your side. So in bear markets, I get pretty aggressive on a short-term basis. Our target 100 strategy was born out of a bear market. And the reason being is you get a much higher volatility spike. And so you can sell very far out of the money on a very short time frame and do pretty well. Now, that strategy is designed to get 2% a day, basically, selling within 5 days out iron condors, bracketing the market effectively. And it works really, really well. I mean, we're talking like I was able to get in the last bear market 250 points out of the money, 250 points out of the money on either side, 4 or 5 days out on the SPX, and do that almost every day. So that strategy worked really well. But then when the volatility crush comes in, that strategy doesn't work as well, right? Which is where like the diagonals come in and the things like what we do with the campaign and that type of stuff, right? And so we have different strategies that we deploy in different markets. Now, I typically every month for me, I'm selling my double, which is a iron condor trade. It's not as aggressive. It's a high probability trade. The goal is to make 4 to 5% return on risk. And those are pretty consistent in any market, but you can sell a lot for all the money in a bear. The biggest place that is the problem with the bear is that initial big move down when it happens. That's where it gets everybody caught. Once that's happened, then you get volatility and stuff, but it's a lot easier. So what you have to really be watching for is if you go to volatile and trending and you're in that for a good amount of time, you have to be watching those higher or those lower highs, those lower lows, because at some point it's going to waterfall off. That's where you got to watch getting caught. I usually like to start entering after that move happens into a bear and start taking advantage because that's your highest level of volatility. And that's where you start to get, some serious, rebound, leveling off and that sort of thing. Up until that point, a lot of times I'll just sell call spreads and just stay above it, and I use that moving average in the weekly charts to help do that. So, yep. So that's my answer to that, Doc.
Well, there's a couple. I do all kinds of things. Let me start by saying that I generally find it much, much easier to trade this, which should not be a surprise because this is fairly linear. You get more repetitive type of price movement. And if there is such a thing as predictability, it's going to be more seen during times like this, right? So when we move into something like this, like Dave talks about that initial shot over the bow that sort of announces like, hey, I'm a bear market and you're screwed, right? This is where everybody is buying the dip and all of a sudden they just went underwater, right? So the transition is always the toughest part. And so we are fanatic about trying to identify those transitions because it's a huge edge. Now, I was actually talking about this in the trading room this morning is, some people were saying, hey, are there any strategies you use? And I've known some bears that are committed bears. And so first of all, I would say to be really good during bear markets, you have to have the right personality. You have to be very, very pessimistic. You have to be, it just takes a different type of person to sort of gravitate towards bear markets, and you see them every day in life. And you got to be in it to win it. You have to be like 100% short moving into these things. So a way that you could do something like that would be you're 100% short on stocks, right? So you're getting bent over backwards, but what you're doing is you're selling puts all the way along here to basically pay for that. And then when the market does release, what you do is you clear that, and then you open up, and then you start to sell calls against here. So that's one way to do it. That's not the way I like to do it. But one of the things that I was experimenting with earlier this year was kind of a derivation of the diagonal that we do. As I started to see, and I think this was back here in August, July and August, as we started to see like stupid, that what I call the stupid moves, then what I was buying was like a 6-month put option, like not quite a leaps, but a long-term put option. And if you buy it during the stupid times, you're going to get it for cheap or a lot less expensive. And so that's incredibly important. And then what you're doing is I was selling diagonals with 30 deltas. And so the 30 deltas, sometimes you're not going to make any money. So when we make money on the diagonal, it's through the short options that we sell that are at and below the money. And the long option is just there to offer margin relief and hedge. And it's the exact opposite when we set these things up for bearishness. So I want to make my money because the volatility will expand on the long option. And really the short option is only there just to pay for the time decay and the positive price drift to the upside. But then once we release, then all the money comes on the long option, just blowing up in value. So there's things that we can do. What you normally find is that the bearish markets don't last very long.
Right.
You got to be in them to win them. You can't jump on these things late because you're going to get a face melting rally from there. I find it very, very difficult. And I think for most people, it's very difficult to try to time what's happening inside of this, this very difficult, this little market storm is really what it is. Mm-hmm. So what I will also do is I will aggressively sell puts. And Dave mentioned this before.
Yeah.
Like I'll go ahead and sell when the volatility expands like that. I'll say, all right, I'll own the S&P down here. What's the worst that's going to happen? Like I get stuck with the S&P 500. Like for an example, what I did back in 2022 is I sold the SSO and I got assigned that at 47. So I got assigned that at 47. I still own that now at 97. Oh darn. So yeah, be careful what you wish for. You can be assigned the stock, and then you turn around and you start selling calls against it, and you try like crazy not to get run over on that. So
yeah, it's a very opportunistic. Bears are very opportunistic. Like when we hit like 20% correction, I typically sell hard into that on put side.
Yeah,
naked puts or even spreads, and I'll go like 6 months out, like, and just sell so deep out of the money. I'll get myself another 20+%, right? Because you want to come down that far, great, I'll take it. But a lot of times you'll get that ripping rally, you'll be able to buy that back for cheap pretty fast, because that vol crush happens in that. Then it comes again, right? So you have to use the swings during a bear to really take advantage. But that's the thing, is like the most of the time the market is in a kind of a quiet and trending higher status. Bear markets, like Doc said, are actually very, if you look at the history of the market, very little time is actually spent in bears. So something to think about there.
There's 2 times I get wild on this stuff. I get wild on this stuff because I get really excited when there's 2 times where you get more than one. Oh, it looks like we lost Dave. Oh, there he's back.
My camera
there's 2 times where actually you get more than one factor accelerating your trade. One of those is if you're buying long puts at the top of a move, because what's going to happen is as the price starts to drop, your long put swells in value, but the implied volatility goes up and it makes it explode in value. So that's one time. The other time is what Dave talked about, is when the price drops really hard, the implied volatility swells, then you sell that. And as you get the bounce back up, the volatility contracts, and the price being higher, if you sold a put, it works out. So you gotta look for those edges where you're stacking edges on top of each other, and that's really cool when that works out, because you get a really quick trade under conditions like that. Okay, I think we are clear on questions.
Yeah, I think we have other questions. Good stuff, though.
Yeah, so exciting times. I think we're going to see some very interesting moves into the end of the year. So is this going to be the beginning of it, or is this just another standard garden variety pullback? I wish we knew. I wish we could come.
I think we will by the end of the week, guys.
Yeah,
we'll have a pretty good idea by the end of the week where this thing's going to go.
I think
and if it goes higher, I think that bodes well for that continued rally into the end of the year. If it does put in a lower high or a lower low, then we know something a little more sinister is happening. We need to be careful.
Yeah, then we're probably changing character into sideways and volatile, and we'll have to change our strategies appropriately. So, okay, guys, thanks for joining us here today. Again, for those of you joining us live and for those of you watching the replay, hope you got some value out of this. We'll be back in a week. So thanks again for myself, Doc Severson, Dave Lukas. We are out. We'll see you next week, guys.
Bye, guys.